G'day, welcome back to this final video in the series on identifying and valuing the best that Australian stock market has to offer. So in this final video, the logic of valuations is that we want to buy at low valuations and sell at extreme valuations. Now I'm talking about value here, I'm not talking about price. So there is a distinction. The ideal is to buy at less than liquidation value. So in other words, if you took the tangible assets of the company and wrapped them all up and sold them to somebody, then ideally you are getting a price which is, or getting a value which is greater than the actual price that you paid. Now the reality is that that's incredibly hard to find these days. When Warren Buffett was starting out doing this 4 or 5 decades ago, there were plenty of companies that were trading for below liquidation value. These days, a lot more is known about companies. They're a lot more exposed. They're covered by analysts, and there's just generally a lot more information. So they still exist to a degree, but they're much, much harder to find. But once you do find them, or you find other equivalent good ones at good valuations, then you really want to let the power of compounding work for you in these high return stocks. Now I defined those high return stocks in the previous videos in this short series, and using tools such as return on equity and other growth criteria that were outlined in those videos. Now Warren Buffett does a slightly different thing. He uses valuation or return on net tangible assets. But whichever yardstick you use, the same concept or the same logic is that you're wanting to basically buy something at a low valuation and then later on sell it at an extreme valuation. Now a company's true worth is related to the revenue streams that it provides to investors. You know, that's the long and the short of it. And especially if that company requires little additional capital, so they don't have to go to the bank to borrow funds, or they don't have to issue more shares to shareholders to raise additional funds. So if they can continue to grow their revenue streams and pay part of that out as dividends to shareholders, and they can do that with the existing cash flow, then that's the sign of a really, really good company. And as I've indicated there, it really frees up cash to return via either dividends, via share buybacks, which is a very powerful thing to happen, and also via just straight out capital returns. Now let's have a look at the actual valuation process itself. The first thing that I do is to determine the earnings per share 5 years out from now. Now that requires some assumptions, and we'll come back to what those assumptions are, and I'll give you an example. So we use prior history as a guide, but we also need to assess for the future of the sector and for the company itself. So that's where the assumptions come in. So we have a history, and that gives us a good yardstick, but we do need to make assumptions about the future. Now obviously you want to be fairly conservative, because from this point in time to 5 years out, there's a lot of things that can change. So your valuation process needs to be quite conservative. The second thing that I do is to assign a realistic price earnings multiple at that time. And again, that's a mixture of history, the typical price earnings band that a share will operate in, and also looking at the outlook for the sector. Now the third thing that we do is then add on 5 years of likely dividends. Now the process that I adopt is to try and identify companies that are paying strongly growing dividends. So we add those 5 years of likely dividends on, and again, based on history, based on future environment, and the likely payout ratio that the company is likely to sustain. And the final thing is then we discount that back into today's dollars. Now I use a 15% discount rate, because my rationale is that any investment that I make, I want to be getting a return of 15% per annum. So therefore I will be projecting forward at the rate of 15% per annum. So therefore, if you're working back in the reverse direction, identifying what a fair share price would be in the future, and then coming back at the rate of 15% a year. And that corresponds roughly to basically half of the future value. So specifically, looking at it from the formula point of view, the future earnings per share is equal to the current earnings per share, which is obviously known, and multiply that by the growth percentage for the next 5 years. We then take that future capital value, that future capital value is equal to the future earnings per share, which we've calculated in line 1, and we multiply it by the price earnings ratio. Then we add on the dividends paid over the next 5 years, and the assumption is that those dividends are going to be rising at roughly the same rate as the earnings per share. So in other words, they're maintaining the same payout ratio. So we get a current value then, which is our future capital value plus dividends, and then we divide it by 2. The dividing it by 2 is bringing it back into today's dollars at a discount rate of 15%. So let's have a look at an example. And I'm going to use a company, Monadelphous Engineering, and the reason I've chosen this one is that they are currently a company that is operating at below valuation because that sector is very much out of sentiment. So the assumptions I've used are earnings per share growth of 12% per annum. Now that compares with the 5-year average of 20%. Now, the 20% per annum earnings per share growth was achieved during a period of the mining construction boom. So to use a much lower figure, I think is fair enough and reasonably conservative. But looking at the business over the next 2 years, I also think that that rate of growth is very, very achievable. Now, I'm assuming that the dividend growth is going to be 6%. Now again, that compares with 20% per annum over the last 5 years, but is also only half of the growth in the earnings per share. So I'm being quite conservative there. I'm also assuming a PE ratio of 12 times. That's what the market will be prepared to give this stock in 5 years' time. Now the reality is that Monadelphous has operated in a price earnings band between 12 and 18 for the last 6 to 8 years. So I'm assuming the bottom of the historical band, which again, very conservative. So if you calculate that through, you come up with a fair value figure in 5 years' time of around $40. So discounting that back, we get fair value now of $20. So any price below $20, you're buying the stock at below fair value. Now if I tweak those assumptions slightly, not very much, but just a little bit, then I could come up with a figure of a little over $50 in the future, discounted back to today around $25. So it's that value is quite sensitive to the assumptions, and therefore if you're being highly conservative in those assumptions, then it basically builds into the added safety that you've got in that investment. So the key points are that the very best investment opportunities are in quality companies and in sectors that have been absolutely trashed and sentiment is poor, because that way you get to buy it below valuation. Also, you find in those sectors that have been really trashed that the sellers are exhausted. All the selling's done and the share price has really only got one way to go, and that's up. So that means you've got extremely small downside risk and you've got substantial upside risk. And the price is well below fair value as a consequence of all of those factors coming together. Now in the case of Monadelphous Engineering, at the time of putting this video together, it was paying around about a 7% dividend, which also puts a floor under the share price. So we're just building layer upon layer of safety factor in there. Now the next ingredient that Buffett uses to produce the stunning results that he has over nearly 5 decades is that it takes typically about 5 to 10 years to really see the benefits of buying great companies and compounding those returns over time, and that's been the approach that he's taken. Now he has a few other advantages. such as he effectively takes control of the company, which we can't do. But there are other things that we can do to gain a massive advantage by timing the market. And so the next series will be a multi-part series on using the power of price charts.
Now, following recent events in America, the way forward is even clearer. I've been really positive for over a year now, but this really nails the opportunity of the decade to my way of thinking. So whatever's been holding you back, just kick it out of the way and get on with it. Our memberships are tailored to suit every type of trader or investor, no matter what your business, family or personal circumstances. For more information or to join with us, visit our website, send me an email. I'd be absolutely delighted to speak with you. The time to strike is now. It just doesn't get any better than this. I look forward to hearing from you soon. Cheers.